Good afternoon, Miss Yuanita and Miss Anissa. My name is Tazskiya Faisal with student ID number 190236063. My analysis for the final big project is PT Telkom Indonesia or TLKM, which is Indonesia's largest state-owned telecommunications and digital infrastructure company. So Telkom is not only a mobile operator, it operates across consumer connectivity, enterprise ICT, towers, wholesale fiber, data centers, satellite, and international connectivity. In 2025, Telkom recorded revenue of 146.7 trillion rupiah and net income attributable to owners of 17.8 trillion rupiah. Its core revenue engine remains Telkom and IndiHome, supported by 156.1 million cellular subscribers and 10.3 million IndiHome B2C subscribers. However, the company is now shifting through Telkom 30 from a traditional telco into a strategic holding focused on asset productivity, portfolio discipline, and infrastructure value unlocking. Next, this is the financial statement analysis. Moving to this, Telkom remains large and cash generative, but the quality of earning is weakening. Revenue grew from 2020 to 2024, but declining in 2025, mainly due to pressure in the B2C segment. The issue is not demand disappearance, but data usage remains high. The real issue is monetization. Higher data traffic does not automatically translate into higher revenue. Margin compression is also visible. Gross margin remains strong, but EBIT margin and net profit margin declined, showing that operating cost, depreciation, financing costs, and business mix changes are pressuring profitability. And on the positive side, Telkom still generates strong operating cash flow, so the company still has capacity to fund capex and transformation. The key question is whether future capex can improve asset returns, not only maintain network scale. And this is the ratio analysis. The ratio analysis confirms the same diagnosis. So liquidity improved after 2020 with current ratio increasing and cash ratio also increasing in 2025. Solvency also remains manageable with liabilities to equity at 0.91 times and debt to asset around 47.7%. However, profitability and efficiency ratio weakened. ROE declined to 16.05%, ROA to 8.45%, and asset turnover fell to 0.51 times. Dupont analysis shows that the ROE decline is mainly driven by lower margin and weaker asset productivity, not excessive leverage. Compared with ESAT and EXSCL, Telkom is still stronger in scale and profitability, but its own historical performance is deteriorating. So the problem is not financial distress, but declining value creation. Next, this is the valuation. So for valuation, we use DCV as the I use DCV as the primary method, supported by relative valuation, Monte Carlo simulation, and sensitivity analysis. The WACC used in the DCF is 13.51% based on a 6.71 risk-free rate, 1.35 beta, 15.74% cost of equity, and 9.36% after tax cost of debt. The DCF produced an enterprise value of 416.6 trillion rupiah and equity value of 357.5 trillion rupiah. This results in a fair value of 3,609 per share rupiah compared with the current price of 2,960 rupiah, implying 21.9 upside. Relative valuation also supports this view with Telkom trading at 6.2 times EV per EBITDA, slightly below the peer weight average of 6.6. Monte Carlo simulation shows most outcomes are above the current price, while sensitivity analysis shows that valuation is highly sensitive to WACC and long-term growth. Therefore, the upside depends on Telkom 30 execution, FCFF recovery, and stronger market confidence in infrastructure value unlocking. Next, this is the real option analysis. In this section, I treat the Telkom's equity as a call option on firm value. So I use two methods, going concern value and liquidation for fair value. Under the going concern method, firm value increases from 294.5 trillion rupiah in 2027 to 326.5 trillion rupiah in 2035. Equity option value rise to 242.3 trillion rupiah with zero model default probability. So this means Telkom has strong equity protection under normal operation. Under the liquidation method, firm value is much lower, only 72.8 trillion in 2035, and equity value falls to 265 per share. This shows that Telkom's infrastructure asset is valuable only if they remains productive and monetizable. The implication is clear here. Telkom's risk is not bankruptcy risk, but execution risk in converting infrastructure assets into cash flow and market value. The capital structure, Telkom currently has a conservative capital structure with net debt per EBITDA around 0.6 times. This is below global telco norms and regional peers. The benefit is low financial distress risk and high flexibility, but the downside is that Telkom may underutilize debt to tax shield. Using tax shield versus distress cost framework, the optimal range appears to be around 1.0 times to 1.2 times net debt per EBITDA. This level is still conservative, but allows Telkom to improve capital efficiency. And additional debt should not be used randomly. It should fund value accretive projects, especially in Farnexia, Nutradisi, fiber, data centers, and Telkom 30 related infrastructure monetization. Next, for dividend policy, Telkom remains attractive as an income stock, but 2025 shows a warning signals. Dividend paid reached 21.05 trillion rupiah, while parents' net income declining to 17.81 trillion rupiah, resulting in a payout ratio of 118.1%. Although FCFF coverage remains healthy at 1.81 times, a payout above 100% is not sustainable if earnings pressure continues. Therefore, we recommend a more balanced payout ratio of around 70% to 75% while preserving room for Telkom, strategic capex, and selective buyback. For the M&A, the key case is the Infarnesia wholesale fiber spin-off. This is directly linked to Telkom 30's value unlocking agenda. The model shows the total target value, including synergy of 77.6 trillion rupiah and M&A NPV of 41.8 trillion rupiah. So, however, much of the value depends on synergies and external tenant transactions. So, Telkom should persist with phase one, but treat phase 2 as conditional. And the last but not least, ESG and final recommendation. So ESG risk is financially relevant with Telkom because it affects operating costs, capex, WACC, and valuation discount. Environmental risk comes mainly from data centers, energy, and intensity. Social risk comes from cybersecurity, data privacy. Governance risk is especially important because state owner and portfolio complexity may create market discount. Overall, the final recommendation is buy. The DCF fair value of 3,609 per share implies 21.9% upside from the current price. Telkom remains financially stable, cash generative, and conservatively leveraged. However, the upside is not automatic. The investment thesis depends on Telkom execution, margin recovery, disciplined capex, financial monetization, and stronger asset productivity. If Telkom fails to convert its large infrastructure base into stronger FCFF, the stock may remain discounted despite its scale. So that is all from me. Thank you.